Grab is Southeast Asian leading ride-hailing and food delivery platform. Its stock price has fallen 80% since 2021 crazy valuations, so I decided to take a look if it offers value at the current market cap. For its entire history, Grab has been burning cash to sell services below market prices in order to boost demand and gain market share. As interest rates were low and investors were lining up to throw money for any promising growth companies, it was easy for Grab to constantly keep raising new capital while burning cash year after year. 2019 revenues were negative. That's because they paid consumer and partner incentive fees higher than their commissions. Incentive fees are deducted from the revenue line, leading to a negative balance. However, they've been steadily decreasing losses and are currently on the way to adjusted EBITDA break-even by the second half of 2024. Due to the consumer and driver incentives, the revenue line doesn't make much sense, so it's better to value Grab based on gross merchandise value, which represents the sum of the total dollar value transactions from Grab services, including any applicable taxes, tips, tolls and fees. In deliveries, gross merchandise value guidance for Q4 2022 is between 2.4 to 2.5 billion. However, it looks like deliveries market is already quite saturated and Grab will likely see only subdued growth rates going forward. Evidence of stagnation is that even though tourism started to recover in Q3 2022 and monthly transacting users were up by 30% year over year, still gross merchandise value increased only by 5% year over year or 11% in local currencies. So in 2023 there will likely be a total of 10 to 11 billion delivery gross merchandise value. On the mobility, Q4 guidance is between 1.1 to 1.15 billion gross merchandise value. In 2019 they used to make 5.7 billion annual mobility gross merchandise value. So as tourism should recover, I'm expecting around 6 billion gross merchandise value in 2023. However, after 2023, the growth rate should also slow down. Then, Grab is building financial services on top of their mobile platform. It is still insignificant and the financial services gross merchandise value will be money losing for several years ahead. When the financial services reach profitability, the margins will be lower than in mobility and delivery, so it doesn't make sense to sum financial services gross merchandise value on top of other gross merchandise value. I cannot tell how big or profitable this part of their business will be or why they will win market instead of some of their dozens of competitors. So for now I exclude the financial services from the valuation and leave it as a free upside potential. However, if they successfully build the financial services platform, it may be a significant part of Grab's value in the next decade. The competition is tough in this industry and nobody can make profits because these companies have been drowning in cash raised from exuberant investors over the past decade. All focus has been on growth and stealing competition market share. However, when the growth rates slow down, interest rates go up and cheap capital is no longer available, these companies will likely rationalize and stop the price wars. My best guesstimate is that the long-term average net income margin is around 3% of gross merchandise value. If Grab reaches the adjusted EBITDA break-even by 2024, it will likely reach profitability around 2027. So far, it all sounds good. However, there are serious problems, which is why I advocate avoiding the stock. There are two red flags: management compensation and gross merchandise value reporting. Let's start with the compensation. The founder has granted himself special voting shares to control the majority of the voting power, while he only holds 3.6% of the total shares. It isn't necessarily bad itself, it just means that you are at the mercy of the founder, and if shareholders don't like the decisions that he is making, there is nothing they can do about it. Where the problem arises is the management compensation. The 2021 equity incentive and stock purchase plans allow the board to compensate management by diluting existing shareholders by 6% annually over the next 10 years. The total share count will increase by 80% over the next decade if the plan is fully executed. The second problem is that management is misleading investors with their gross merchandise value numbers because they don't fully own all of their operating entities, but they keep reporting the gross merchandise value part that is going towards non-controlling interest as if it was part of their gross merchandise value. Crab owns 46% of the Indonesian entity, 49% of the Vietnam entity, 40% of Philippines entity, and 44.4% of Thailand entity. They don't break down how much of gross merchandise value is coming from each country, so I have to assume that the gross merchandise value going towards Crab shareholders is around 50% less than what they are reporting to us. So instead of using mobility and delivery gross merchandise value of 18 to 19 billion for 2023 that the management is trying to defraud you into believing, they will only make around 8 to 9 billion gross merchandise value towards Crab shareholders. I tried to contact investor relations twice to confirm how the gross merchandise value is reported and to get more information about the management compensation performance requirements, but they decided to ignore me. So far, share-based compensation expense equals around 3 to 4% dilution in the first 9 months of 2022, so it will be slightly lower than the 6% annual dilution. However, going forward, there is no reason to assume that the dilution will be any lower than the annual 6% share-based compensation board of directors is authorized. As the founder controls the majority of the voting power, he can choose all directors. On top of that, he even sits on the compensation committee, deciding the directors' salaries. If he doesn't like some directors' decisions, he can just vote them out and pick new directors to replace them. In theory, the directors in compensation committee should be independent, but in reality, they are totally dependent on doing whatever the founder asked them to do. In Q3 2022, there was 4,440 million net cash on the balance sheet. Currently, annualized operating cash flow burn rate is around 800 million. They will keep burning cash over several years, but the burn rate should steadily slow down. They may still burn between 2 to 2.5 billion cash before reaching profitability, so I'll assume that the net cash, which can be invested or distributed to shareholders, is around 2 billion. If the 18 billion gross merchandise number was accurate and there was no crazy management compensation plan, then the net present value with the 10% discount rate would be 15 billion, making it a solid buy. However, the real gross merchandise value is only 9 billion, and I also have to lower the annual growth rates by 6% to adjust for the annual expected dilution, which lowers the net present value below 5 billion. I usually don't like to talk about fairy tales or science fiction. However, if you are fundamental investors and invest in Crab, you must have a very long-term vision, because even if they are successful, it will likely take at least 15 years before they can generate an equal amount of free cash flows to cover the current market cap. So, if Tesla or some other company figures out how to make self-driving cars work, Crab's business model will be obsolete. It shouldn't be a short-term threat, but I would be surprised if nobody figured out how to make self-driving cars over the next 2 decades. I hope it's needless to say why self-driving cars would destroy their business model, as the cost per drive would be at least 50% lower. I'm sure these ride-hailing companies' CEOs would say that self-driving cars can operate in their networks. However, whoever figures the self-driving cars can just create their own app and instantly take the entire market share. There is no economic incentive to share profits with the existing ride-hailing platforms. So, to conclude, the founder CEO whose ownership was almost entirely diluted by the previous capital raise rounds, is eager to take his stake back with a very aggressive and corrupt share compensation program. He is putting his own interest first while abusing corrupt shareholders. Management is also trying to mislead investors by presenting inflated gross merchandise value numbers. There are uncertainties about their business model's sustainability when we take a very long-term, 2 decades outlook. So, why would you want to invest in a company where management is greedy and fighting against you? There are plenty of better opportunities to invest. Thank you for watching the video and have a nice day. Bye.